You reach the end of the month, the bills are paid, and for once, there's a little money left over. But instead of feeling a sense of achievement, you feel a mounting pressure, the sudden, heavy responsibility of deciding exactly where to put it. The second you look for answers, you're met with a wall of noise. Your friends, family, and social media feeds are all contradicting each other, insisting that the only smart move is stocks or gold, or the guaranteed safety of a fixed deposit. This constant stream of conflicting advice creates a specific kind of paralysis. Because you've worked hard for these savings, the fear of picking the wrong one and watching that money disappear feels very real. When everyone claims their way is the best, we naturally start looking for a middle ground, a single investment that offers high growth but carries no risk of loss. But by focusing on finding that one perfect product, we're asking the wrong question. To actually move forward, we have to stop comparing the names of these investments and start looking at the mechanics that actually drive them. Financial markets are organized around a direct relationship between the profit you hope to gain and the uncertainty you are willing to accept. We can visualize this as a scale. To evaluate any investment, we have to plot it on this line to see exactly how much safety we trade away in exchange for a potential return. At the far bottom left, we find fixed deposits. This is our baseline for safety. Your money is protected, but because the risk to your capital is near zero, the growth you receive is equally small. Moving up the line to gold, we see a shift. Historically, gold can provide better long-term growth than a bank account, but it introduces price fluctuations. The value of your investment will go up and down from day to day. This shows us the first reality of the market. If you want your money to grow faster than a savings account, moving to the right on this scale is a requirement. You cannot have maximum growth and maximum safety at the same time. To reach for higher returns, we have to move into market-linked assets. Mutual funds allow you to pool your money with other investors to buy into a diversified mix of companies. While the long-term trend for a mutual fund is often upward, the path isn't smooth. Because these are tied to the stock market, you have to accept the reality of temporary losses along the way. If we move to the extreme end of the scale, we find direct stocks. By picking individual companies, you gain the highest potential for wealth creation, but the line representing your journey becomes much more aggressive. In this tier, the drops are steeper and more frequent. If a company fails or the market enters a downturn, a significant portion of your investment can be wiped out very quickly. This is the emotional price of the stock market. To earn those higher returns, you have to be comfortable watching your balance drop during a crash, whereas lower risk assets like gold or FDs provide more peace of mind. Ultimately, where an asset sits on this scale doesn't make it good or bad. The scale simply shows you the price you are paying, in the form of volatility, for the chance at a higher profit. This means the best investment isn't something you find in a news headline. It's something you calculate based on your own life. Every investment choice should be filtered through 3 specific factors: your goal, your time horizon, and your personal risk tolerance. The right choice for you is where these 3 overlap. For example, if your goal is to save for a house down payment that you need in just 6 months, your time horizon is very short. In that short window, you can't afford a market crash. Protecting your original cash is more important than growth, which makes the low-return fixed deposit the mathematically correct choice for that specific goal. But if we change the scenario to a retirement fund you won't need for 20 years, the logic shifts entirely. With 2 decades of time, the short-term spikes and drops of the stock market matter much less. You have the time to wait for a recovery, allowing you to prioritize the high growth of stocks or mutual funds. This is why there is no universal winner. The best investment is simply the one that matches your personal timeline and your ability to handle ups and downs. If the math fits your life, the outside opinions don't matter. But even if we use this framework, we're still assuming that one of these options, the fixed deposit, is a perfectly safe, zero-risk choice. The truth is, while your money sits in that safe vault, an invisible force called inflation is slowly eroding what that money can actually buy. In the next episode, we'll look at the hidden risk of playing it too safe.
Like, share, subscribe कर दो यार